Investors around the world are waiting for this morning's remarks from Fed Chair Jay Powell from the Jackson Hole Fed Symposium. Joining us now on what he's expecting, former Fed Vice Chairman and CNBC contributor Roger Ferguson. Roger, can we just do 2.5? Can you agree with me on that? Is that good enough? Can we move it to that for inflation? Can that? I mean, we're there. Can't we just say that's pretty good?
Look, I think we can say it's pretty good, but I think they are going to continue to say the target is 2% for a reason that I think you've already pointed out, right? Because as soon as you let go of that target, then the market is going to become a little unanchored and expectations will be hard to manage. So I'm expecting a repeat of the notion that we are aiming for 2% and there's some way to go.
I heard a new term called the what did Steve call it? Is it the sacrifice ratio or something? And it's what we give up to get inflation down in terms of economic growth. And Steve said it's been zero. Should we embrace that? And that's great that inflation's come down and we haven't seen unemployment go up. Or is that a problem for the Fed that they, in the back of their mind, they might think that they still need to raise unemployment by a half of a point or a point or whatever?
I think at the end of the day, it's a bit of a conundrum for the Fed, which is almost everyone on the Fed now has been trained with this notion that unemployment has to rise if you bring inflation down. However, that has really come under question for quite a period of time. So actually, I think at the end of the day, they're rather hoping to get what one might describe as an immaculate disinflation, bring inflation down the target without having to raise the unemployment rate too much. And to date, they've managed to succeed at that. So I think it's a fingers crossed. Let's hope that the old relationships are not holding, that there are new relationships that allow the Fed to bring inflation down without crunching the employment picture, because by definition, everyone wants to have full employment if possible, while also having inflation under control.
Given what the Fed's already done, is a recession already in the cards? We've taken that off the table, at least in the near term. But have they done what they've done so far? Will that cause back-to-back quarters of negative GDP growth, or just maybe a bit of a slowdown?
Well, as you know, there had been a great deal of recession talk earlier. Most forecasters now are backing away from that. I think the expectation is that a soft landing or a soft-ish landing seems more likely than not, but certainly that involves a period of what they call below-trend growth. And so I would describe it as probably a rocky kind of landing. It may not necessarily be a technical recession, but certainly growth is going to have to continue to slow a bit, and is likely to slow given how much they've raised rates and how much the market also has raised rates.
Roger, given that we're walking into a presidential election come the fall of 2024, when you talk about a rocky landing, when does that landing happen, and how do you think that impacts the thinking of the American public about how good or bad the actual economy is?
That's one of the interesting dilemmas here. So, as you know, the discussion of recession or slowing keeps getting pushed out. And so now most people who are thinking of a softish or maybe a rocky kind of landing are looking in the first part of next year. I think that will probably force a number of conversations where there will be a lot of cross currents around the economy. If we're lucky, inflation will be under control, and so that will no longer be, a household topic. If they're lucky, the unemployment rate will not skyrocket, and so people will be able to talk about a strong labor market. Average hourly earnings are continuing to go up. That will be helpful. So it's going to be, I think, a mixed story potentially a mixed story when it comes to the economy and the election year, with both parties having something that they can point to as a strength or a weakness of the other side. So we'll see how that plays out.
One of our earlier guests who watches this very closely, Shri Kumar, said the highs are in on the 10-year, 4.3% or 4.32 or whatever. I'm not going to ask you to bet, but if I were going to put money down, what would you tell me to do? Would you bet that rates go above 4.3 eventually, or do you think that those are the highs?
I think the possibility is that rates go a little bit higher, and that's because there looks like there's continued strong momentum, in the economy. I think there's an increasing optimism that, as we said, the Fed will avoid a recession. And all of that is a suggestion that maybe the economy is, a little stronger. If we're lucky, we'll get inflation under control without crunching the economy. And that allows rates, I think, the 10-year to continue to rise just a little bit. So I wouldn't get overly excited about it. But I don't necessarily think we've seen the absolute tippy-to-top high here, possibility of rates going slightly higher.